This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 426 was produced on May 2nd, 2024. I'm Eric Townsend. Santiago Capital founder Brent Johnson returns as this week's feature interview guest. We'll get an update on Brent's dollar milkshake hypothesis vis-a-vis the current rally in the dollar against other currencies, the big move in gold, and the looming question of persistent inflation. Next week, May 9th, Patrick will be in Mexico leading the big picture trading event there. So we're going to modify our usual show format next week, similar to our holiday specials. The entire show will be an extended-length feature interview with Copenhagen Atomics founder Thomas Jam Pedersen. The subject will be the role thorium fission will play in energy transition and the benefits of molten salt-cooled and liquid-fueled thorium-burning nuclear reactors over conventional light water reactors fueled by uranium. We'll be back to our usual format on May 16th when Patrick returns from trading in the sun south of the border.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, May 1st, 2024. The S&P 500 June futures were down 119 basis points, trading at 5,046. The pattern of selling rips continues in the post-FOMC. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index down 18 basis points, trading at 105.63. There was a material trend shift in that U.S. dollar yen that may be influencing the dollar moving forward. That June WTI crude oil contract down 460 basis points, trading at $79 even. It was a break of the 50-day moving average and approaching those January-February highs. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The June RBOB gasoline down 517 basis points, trading at 257. Key breakdown after struggling at resistance levels over the last month. The June gold contract down 115 basis points, trading at 23.11. The multi-week correction underway, asking the question, is this the buy on dip? Copper up 247 basis points, trading at 457. Uranium up 426 basis points, trading at 91.75. Back above 90, but will the bulls be able to follow through with it? The U.S. 10-year Treasury yield down 1 basis point, trading at 464. The key news to watch this week is Friday's ISM services PMIs and the jobs numbers. Next week, we have the Bank of England monetary policy statement and the University of Michigan consumer sentiment numbers. This week's feature interview guest is Santiago Capital founder Brent Johnson. Brent is known for his dollar milkshake theory, predicting the appreciation of the dollar against other currencies. This interview will include an update on how Brent's dollar milkshake hypothesis is evolving. Eric's interview with Brent Johnson is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Santiago Capital founder Brent Johnson, who's also the author of the dollar milkshake theory. Brent prepared a slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com. Look for the red button above Brent's picture that says looking for the downloads. I strongly encourage you also to go to macrovoices.com if you are a new listener and are not already familiar with Brent's dollar milkshake theory. We've done a couple of episodes where we went into much deeper detail on the dollar milkshake theory specifically. I think that content is more relevant today than it was on the day it was recorded several years ago. So for full context on dollar milkshake, go there. Brent, why don't we start with, just for our newer listeners, a quick summary of what the dollar milkshake theory is. People who want more detail can go back to the prior episodes.
First of all, Let me just say thanks for having me back on here, Eric. It's always fun to talk to you, especially about, kind of this topic and just macro in general, because you and I have been talking about this, a couple times a year, every year since I first started talking about the US dollar. And the reason I talk about the US dollar and the reason I focus on the US dollar is, in my opinion, it's the single most important factor in getting the overall macro picture right. I think it's very difficult for your portfolio to do well. It's not impossible. Nothing's ever impossible, but I think it's very difficult for your portfolio to do well if you don't understand what's going on with the dollar, and especially if you get it wrong. And so essentially what the dollar milkshake theory is really just a framework and a way for me to look at kind of an event-driven thesis that's based on the fact that I believe that we have too much debt in the world. And I believe that debt has consequences. And I think what we're going to see in the years ahead is the consequences of all that debt that we've taken out, both in the United States and outside the United States, play out in the markets. And I don't think I'm unique in this. I think everybody sees the problem of having too much debt. But in my opinion, many people seem to get the knock-on effects of having all this debt wrong. And so I kind of came up with this theory, and I call it a theory because I think it's right. I think it'll be right. So far, it's been right. Well, I guess we kind of have to wait and see ultimately whether it's right. But I had to come up with a way to explain to my clients who are very smart, very successful, very wealthy, but aren't necessarily, versed in traditional financial lingo, and they don't study monetary history or monetary policy. So I had to come up with a way to explain to them what I thought was going to happen. And essentially, what I was saying, what I thought was going to happen was that there would be kind of 6 main things that I wanted to get across to them. One is that we'd had this 40-year bond bull market. And I was of the opinion that I didn't know exactly when, but I thought as a consequence of taking on all this debt, interest rates would eventually have to rise and they would break out of this long-term 40-year descent towards zero. And I thought that when when interest rates go higher, then bonds break, right? Bonds go lower. And when bonds go lower, then interest rates rise. When interest rates rise in the United States, that typically pulls the dollar higher. Well, the dollar going higher versus other fiat currencies creates all kinds of problems for the global markets. And I think a lot of people thought that that might happen, but that would cause this huge bear market, another Great Depression, however you want to describe that. And while I thought that was possible, I didn't think it was necessarily going to happen right away. And I didn't think those would be the first steps. And what I actually thought would happen was that we would have a rise in equities alongside the dollar. And I thought we would have a rise in gold alongside the dollar. And just really in general, I thought the United States would far outperform the rest of the world. And so that's really the thesis. And, over the last 6 years, 5, 6 years, that's for the most part played out. Now, it's not perfect and it hasn't always worked that way. And of course, there's been times where things have gone against it and, markets don't move in straight lines. But as I look back, and for people who think that I'm just making this up, I did an interview in the summer of 2018, and this interview's online and the transcript's online, and it's all right there. And then I did a very short presentation of it in October of 2018, where I talked about it a little bit more. But the very first time I talked about it to kind of a captive audience and really went into detail was at your MacroVoices conference in January of 2019. And so it's been kind of fun for me to kind of track and see how this has gone. And I have to say, it hasn't been perfect, but for the most part, I think it's been right. And it's allowed me to, manage my client portfolios without suffering significant drawdowns and participating in the upside along the way.
Brent, something I've noticed is sometimes people don't listen carefully enough to what you're saying. I've heard quite a few people interpret your dollar milkshake message to say, that Brent Johnson guy, he's a dollar true believer. He's the guy who's just super bullish on the U.S. dollar. He thinks there's nothing wrong with the U.S. dollar and the system is not broken. I don't think that's an accurate interpretation at all. So is the U.S. dollar broken? And particularly, help people who might be confused by that understand, how can the dollar system be broken and failing, yet you're still predicting that it outperforms every other currency in the world?
Well, this is kind of the ironic part of it. And I do believe there's this disconnect between what I actually say and what people think that I say. So, sometimes macro can get confusing. So I bear some responsibility of this as well. But essentially, what I have said is the U.S. has many, many problems, probably too many to list. And the U.S. dollar is an extremely flawed currency, probably too many flaws to list. But based on the design of the system and based on this quote unquote, sovereign debt crisis or currency crisis that I foresee coming, I don't think that means the dollar goes down. I actually think it means the dollar goes higher. And it's because of all the problems that the dollar will go higher. And perhaps this is not fair. Perhaps this isn't the way it should be. But as an asset manager, I try not to get too emotional and I try not to put my moral judgments on the system. My job is to analyze the system as it is and figure out what's going to happen. And all my analysis tells me that as we get into more trouble, the dollar will go higher. And then the dollar going higher in and of itself creates more trouble. If anybody doubts this, if you look at I'll just go to it really quickly, slide 11 in the presentation. Over the last 25 years, anytime there has either been some kind of a global economic slowdown or a crisis, it has coincided with the dollar rising versus foreign currencies. Now, whether the dollar going higher causes the crisis or whether it goes higher in response to the crisis, I'm not smart enough to know that. Maybe it's a little bit of both. All I know is that the correlation is 100%. And I don't think it will be different this time. If you do think it will be different this time, you're welcome to manage your portfolio however you want. But I have a fiduciary duty to my clients to not only try to make money, but also protect on the downside. And if I see a possibility of a rising dollar, however small, I have to plan for that. And I think it's more than a small possibility that the dollar will go higher. I think there's a high probability that the dollar will go higher. And as a result, I need to figure out a framework to manage my clients' assets through that. If people look at just slides 5 through 7, this shows that the assets that I spoke about, I said interest rates would go higher, the dollar would go higher, gold would go higher, and U.S. equities would go higher. And I put out 3 different slides, one from the very first time I ever mentioned the milkshake theory, one from the first time I talked about it at your conference, and then the second time or the third time that's since the COVID lows. And if you look over all those timeframes, of course, there's times along the way where they don't all go in that direction. But overall, under all of those timeframes, all 4 of those things are higher now than when we started. And that, again, that having this framework has allowed me to kind of understand what's going on in the markets.
Brent, I'm probably one of the people who's guilty of conflating your dollar milkshake theory to have some other meaning that I made up in my head. Something I've noticed is a lot of people seem to think that you and our mutual friend Luke Groman have opposite views and that you disagree on everything. I don't interpret what you guys are saying that way at all, because Luke's message is, look, the U.S. dollar, because of so many mistakes the U.S. government has made, is going to lose its reserve currency status, and eventually the U.S. dollar is going to crash against other currencies. And most people say, well, Brent Johnson says the opposite of that. And what I've always thought is, no, you guys are both right. What I think is happening is, for many of the reasons that Luke has stated, the U.S. dollar is going to lose its reserve currency status. But the only way that ever happens is you go through some really, really difficult turmoil in the world. And the way I've interpreted your theory is, that turmoil means that the dollar appreciates relative to other currencies, because for now, it is still the global reserve currency. It is what everybody goes to as a safety trade asset. It is going to appreciate against other currencies through a whole bunch of turmoil, until eventually that hits a crescendo and other countries see there's just too many problems and they take some really extreme actions, maybe take some losses along the way. And it's in those extreme actions that Luke eventually gets proven right, but not until you're proven right first. So that's my interpretation of this. Is that consistent with your view, or is that just something I made up in my head?
I think that's a fair way to say it. I think the main differences between Luke and I is that I manage money and I have to mark a book to market every month, every quarter, every year. I think in many ways, Luke talks more kind of theoretical and from a research perspective, what could potentially happen. Ultimately, I think the big difference is one of timing, which you pointed out, and then the difference is the probability of these things playing out. in my opinion, and again, I'd be happy to say this if Luke was here. Sometimes I get asked about Luke a lot, and I never like necessarily talking about him when he is not here to give his own spin on things. But my position on Luke is that he says a lot of things, and it seems like that's a very high probability event, where I would say, yes, it's possible, but it's a very low probability event. And then I would also say it will take much longer for these things to happen than he thinks that they will. So I don't think your interpretation is wrong necessarily. I would just put that qualification on there. The other thing that I would say is that it's not that the world can't de-dollarize. Of course it can happen. And it's not that people don't want to de-dollarize. Of course they want to de-dollarize. My position is that the world cannot de-dollarize without incredible economic volatility, and probably not without military violence. And in either one of those scenarios, whether it's military action or whether it's just great economic chaos, I think the dollar goes higher in that scenario. And for people who think that the dollar can't go higher, I think in that scenario, their portfolio could get severely impaired, at least in the short term. Now, if you have a 5 or 10 year time horizon and you don't have to use your portfolio liquidity and you have a second source of income, perhaps the timing doesn't matter. But most of the people I speak to, and especially a lot of the people I manage money for, are either in retirement or moving towards retirement. They can't afford or don't want to experience the pain associated with a 20, 30, 40, 50% drawdown in their portfolio. So for me as an asset manager, the path to the destination is extremely important. And so I think that's one thing that many people get wrong. I think some people say, well, I can just buy gold. I can just buy Bitcoin. I can just, put my money in international stocks. I don't need to worry about what happens in the United States, and it's no problem. And I think that is an extremely naive interpretation of how things are going to play out.
Brent, going back to slide 4, I think that last point, number 6, is where some people misinterpret what you're saying. Because when you say the U.S. outperforms the rest of the world, I think it's so essential to understand you're saying on a relative basis. Because some people will hear that statement as, oh, Brent's saying there's nothing wrong with the U.S. economy or the U.S. debt and, our fiscal situation is fine. It's the rest of the world that's screwed up. That's not what you're saying. What you're saying is everything is so screwed up that what's going to happen is because the U.S. is the anchor currency, the U.S. dollar is going to do well, and also there's so many problems in the rest of the world that are worse than the problems that exist in the U.S. Is that the right interpretation? Because I think that's where some of the confusion is. That's
absolutely correct. So again, I would encourage people to go back to the very first interview I ever did on this, and it's online. And if anybody can't find it and wants to find it, they can email me and I can send it to them. But I think in the very first sentence, or at least in the very first minute, I said, I want to be very clear. This is a story that ends very, very badly. And, I think when this happens, when we get into this crisis, it's not that it's going to be good for the U.S. I just think, as you point out, it will be better on a relative basis than the rest of the world. And the other thing that I think people sometimes misinterpret is number 2 and 3 on this list. Again, this is on slide 4. Some people think that I'm this uber treasury bull. And listen, I can paint a picture where treasury bonds do very well in some kind of a risk-off scenario, but that's not the core part of the thesis. The core part of the thesis is that we got into this place where the 40-year bond bull market ends, interest rates start to rise as a result of all the debt and all the uncertainty and inflationary pressures. As a result of interest rates rising, the dollar goes higher. So dollar often trades inversely to bonds, and it's the interest rates going higher, in other words, it's the bonds going lower, that is pushing the dollar higher because it makes the dollar more attractive relative to its peers that have much lower interest rates. And the other thing, to your point, is that it's not that things aren't bad in the U.S. It's that when things go bad in the U.S., it creates a nightmare for the rest of the world. And again, I'm the first to admit, this is not fair. Perhaps this is not the right way things should be. But I'm trying to get across to people that I think this is the way things are. And I think many people, again, have the knock-on effects of things going bad in the world incorrect. And when things go really bad in the U.S., they become even worse overseas because the dollar underlies the entire monetary system.
Brent, something I have become convinced of in recent weeks is that gold rising in a completely different correlation to other assets. So we've got gold going up at the same time that the dollar is going up, and at the same time as we've got real interest rates recovering. So we don't have deeply negative real interest rates anymore, at least on paper, and there may be in the reporting that's going on. I'm convinced this is the most important signal we've seen in financial markets in 20 years. What does it mean? Drum roll, please. I don't think anybody knows for sure. I really want to get your take on what it means that gold is doing, first of all, such an incredible meteoric climb that we've seen in the last couple of months. What's driving it, but why is it out of correlation and almost opposite what you would expect given real rates?
Well, I think this is really kind of the point that I've been trying to get across for several years. And it goes back, if we go back to this, again, this list on page 4, the dollar rises, gold rises. When I first started talking about this, I would say, I don't know the exact timing, but we will have a period where dollars and gold rise together versus all the other fiat currencies. And again, if you go back to this original interview, I made it very clear that dollar and gold, I think, are both currencies. And I think those two will rise versus all other currencies. I also said in that interview, I don't know the exact timing of this. And even though I would like to lay it out in kind of this linear storybook title or storybook way so that it kind of makes sense to everybody, I don't know exactly when this is going to happen or that's going to happen. But I think that we'll get into a period where dollars and gold rise together. A lot of people told me that couldn't happen. Part of the reason they said it couldn't happen is they said typically the dollar goes inverse to gold, so you can't have those two rising together. Other people told me, no, because gold moves with real rates, and if interest rates are going up, then that would push gold lower. Again, interest rates going higher is the same thing as dollar going higher because, again, higher interest rates pull capital into the dollar. So I've been trying to get across the point that I thought we would get into a point where real rates would rise, but gold would rise with it. And that's kind of what we're seeing. I think that's happening for a couple reasons. And I think the reason it's breaking the long-term correlation, which you highlighted, is several reasons. Number one, I think there is this wide kind of acceptance or acknowledgement or realization, however you want to describe that the world is in trouble, that fiat currencies are in trouble, and that governments around the world have kind of gotten themselves into a bad situation. And the way that they're going to try to get out of this bad situation is by either financial repression or by inflating away the debt or whatever it is. And again, this applies to all currencies, all fiat currencies, not just the dollar. So that's part of it. I think all fiat currencies get debased. The second thing is I think that, again, the rest of the world is in more trouble than the U.S. And as a result, the dollar's rising versus their currencies, and those markets are seeing a bigger demand for gold than the U.S. If you look at the buyers that are driving this price higher recently, it's mainly from Asia and outside the United States. There has been buying in the United States, but the demand in the United States has been dwarfed by the demand overseas. And that kind of makes sense because the demand overseas is coming from countries whose currency is falling dramatically versus the dollar. The yuan is down 15% versus the dollar over the last couple of years. When the average Chinese citizen goes and buys gold, they're not buying it because they fear the dollar is going to lose value. They buy it because they know the yuan is going to lose value. So I think that's part of it. I think the third part of it is the geopolitical tensions are at a level or as high as any time I've been alive. Now, I kind of grew up during the latter stages of the Cold War. I can remember all the Rambo movies, the Russians were the bad guys. I can remember the movie Red Dawn, where the Russians kind of came over Canada and took over the United States. And the Wolverines were the rebel group that kind of fought back the bad Russians. There was a movie called The Day After that was kind of a controversial movie about a nuclear war. This is all when I was 10, 12, 13 years old. And then we kind of got into this golden age, the 90s and early 2000s where the Cold War thawed and, we had this globalization and everybody kind of cooperated with each other. But it didn't take that long. And now we're kind of right back to that. And, for better, for worse, whether you agree with it or not, the policies taking place in Europe, specifically with Ukraine, has pushed Russia to the edge. And I think people are realizing that, Putin is not going to back down. Now, whether he should or not, again, that's a completely different question, but I just don't think he's going to. And I think the world is largely starting to recognize that. And so there's a big possibility that, this erupts into a greater conflict. And what does better in great conflict than gold? So I think there's several things that are working together to push gold higher.
I agree with everything that you said. I think all of those drivers are in play. I'm surprised you didn't mention one, though, which I think is, frankly, I don't think anybody in the West is really picked up on it yet. But regardless of what you think about the actions that Vladimir Putin has taken in Ukraine, I'm not endorsing anything that he's done. Please don't, interpret my words that way. But what just happened, Brent, is the U.S. House of Representatives just passed a bill which authorized the U.S. government to say, look, let's play God here, because since we're bankers to the world, what we can do is, without any court action, without any United Nations resolution, without anything else, just because we're the U.S. House of Representatives, we're American, we're used to telling the rest of the world what they are and are not allowed to do, let's take this opportunity to do that. We'll seize all of Russia's foreign reserve assets that are denominated in U.S. dollars, because the U.S. dollar is the world's standard for central bank reserve assets. We'll seize the assets of one country and give them to that country's direct enemy as a way of us basically playing God and deciding what the outcome of this war should be as the banker. And, I completely understand the role of the United States government as a military force wanting to side with one country or another. But when, as the banker to the world, we take this position, we're sending a really important message to all of the central banks of the world, which is, if you continue to keep your assets denominated in U.S. dollars and you ever piss us off, we might seize them and give them to whoever we think your strongest enemy is. Just be ready for that to happen. Are people going to continue to keep using the U.S. dollar denominated asset as the central bank standard reserve in that environment?
Well, I think there's two, there's probably several, but I think there's a couple things here with regards to that. So you're right. I should have mentioned that, and I overlooked it, but I should not have. I do think that is part of the reason. Again, I think the world is largely recognizing that we're in a bad place. The whole world, again, not everybody else, except for the United States, everybody else, including the United States. And I think that they realize that, we had this period of globalization. Now we're kind of have this period of deglobalization. We're kind of getting a global divorce, for lack of a better way of saying it. And, you don't quite trust the people, even though maybe you still love them, you don't quite trust them the way you used to. And I think in the years ahead, the fact that the U.S. confiscated Russian reserves and then is now going to give them or lend them or whatever they end up doing with them to Ukraine or to Europe to use to fight against Russia, I think that will be looked at as a mistake along the way. I do think that there's two sides of this story, though. I think if Russia didn't realize this was possible, then they're pretty naive, because we've confiscated many things in the past. Now, maybe not against a country like Russia, but it has happened before. And one thing I would say is two things to this. One is, sometimes when the bully acts like this, it galvanizes all the other kids to gang up and go beat up the bully. I fully admit that sometimes happens. But I've been on the playground with bullies before, and I've seen this in person, and it doesn't always go that way. Sometimes the kids who didn't get beat up will run up next to the bully and befriend him, because they don't want the bully to take out his anger on them. And so I don't think it's quite so clear that the U.S. is going to have to go it alone now, because, the rest of the world is just going to reject U.S. hegemony. But I would say that this is definitely a marker on the road. The other thing I would say is, again, let's say that perhaps the rest of the world does not put their savings in treasuries to the same way that they used to. Again, that kind of goes back to the thesis that, again, go back to page 4. Bonds break, interest rates rise. If the rest of the world does not buy treasury bonds to the extent that they used to, and interest rates rise as a result, that makes the dollar stronger, which causes a lot of these problems that I foresee. So if the rest of the world rejects treasuries, I don't think that that rejects my framework. The other thing I would say is you've heard a lot about this term fiscal dominance, right? The whole world needs US dollar funding. Now, perhaps you don't think that they should, and perhaps that you don't think it's right. But again, the whole world needs US dollar funding. The rest of the world, forget the US, owes over 30 trillion in US dollar debt and has over 80 trillion in off-balance sheet derivatives in US dollars. So the whole world has need for dollars. Now, the idea that the US Treasury is not going to be able to get dollars, but that a corporate entity in Turkey or China or Europe or South America or Australia is going to be able to get dollar funding, I think is completely wrong. So again, I think we are in this period where interest rates are probably going to go higher. I think we are in this place where fiscal dominance as a result of the US budget deficit widening happens. But I think the US will get dollar funding before anybody else gets dollar funding. And as they do that, that deprives the rest of the world of this much needed dollar funding. And I think that potentially leads to defaults. And then that leads to more economic chaos. And when economic chaos happens, then what do the local politicians do? They start blaming the evil foreigner. And then you get higher geopolitical problems. So I think all of this stuff is related. And I think in many ways, the die is cast. We just have to sit here and wait for the game to play out. Now, as I bring this back to gold, I want to make something clear. I have always thought everybody should own gold. But I am not somebody who thinks that gold can only go up. I am not somebody who thinks that every time gold goes down, it's due to some, evil manipulation. And I do not think that somebody should have all of their portfolio in gold. My clients typically have, anywhere from 10 to 25% of their portfolio in gold, depending on their individual and personal situation. And I know there's been times where I've been on this show before, Eric, where I have said, I own gold, but I expect it to pull back. Well, here's the thing. I actually had somebody call me out on this a couple of months ago. They said, well, Brent, last time you were on MacroVoices, you said, yeah, you own gold, but you expect it to pull back. So I went back to the last 4 times I've been on your show. And I don't remember exactly what I said on every show. But I know in general, for the last 4 years, I've said, listen, I think everybody should own gold. It should be the core of your portfolio. But I don't think you should be 100% in gold. And, it wouldn't surprise me at all if it pulls back. So I went back and I looked, and sure enough, the last 4 times I came on the show and I gave that opinion, the first time it pulled back 16%. The second time it pulled back 8%. The third time it pulled back 10%. And the last time it pulled back 7%. It's really only in the last 2 or 3 months where gold has really broken out. So I think we do have a change of behavior here. If you don't own any gold, you should absolutely go buy some gold. I want to make that clear. If you already have a full allocation like I do, then you don't need to go buy it here at all-time highs. I would not buy gold. Since I already have a full allocation, I would wait for it to pull back. If it doesn't pull back, that's fine, because I already have a full allocation. But if it pulls back to 2,100 or 2,000 or 2,150 or whatever it is, then maybe at that point I would buy some more. But again, I think people who are in this all or nothing mentality, 100% in Bitcoin, 100% in gold, 100% in NVIDIA or AI or whatever it is, I don't think that's the right way to manage a portfolio. So I think everybody should absolutely own gold, but I think you got to be careful as well. Markets don't move in straight lines.
One of my theories about what's going on with gold is historically, when you see a hot CPI print, people have in the past seen that as gold bearish, because the thinking is, okay, if there's a hot CPI print, it's going to make it that much more likely that the Fed is going to increase interest rates in order to counter inflation, and that effect on real yields is going to be negative for gold. I think what's going on here is people are saying, no, wait a minute, we're into a new game now. We're into the game where inflation is about to start to run away, in the sense that the Fed's not going to be able to afford to increase interest rates enough to fight inflation, because if they did so, they would completely corrupt the U.S. government's ability to service its debt. So they're going to have to let inflation run away. That's going to mean that real yields, maybe not reported real yields, but real world real yields are going deeply, deeply negative, and they're going to lose control of it. And that's ultimately super bullish for gold. So I think that signal of what hot inflation reports mean might be changing its meaning for the market. Would you agree with that?
There's definitely a change of behavior. I tend to agree with you. We may disagree a little bit in that I do think that, I think $2,400 is a pretty good price for gold. It would not shock me at all to see it pull back here. In fact, I kind of expect it to kind of trade sideways, maybe even pull back over the summer. Now, I want to be clear. This should not keep people from buying gold if they don't already own it. I think absolutely everybody should own gold. And since I already have a full allocation, I don't need to buy more. But what I will tell you, Eric, this may slightly go against what you believe, but I do have puts on silver. A few weeks ago when silver hit 29, I can tell you that the day it hit 29, people on Twitter were just losing their minds, bullish silver. The RSI was as high as it's been in 5 years. The sentiment was as high as it's been in 5 years. And the caught positioning on silver is starting to get fairly bearish. And so I bought puts on that morning, and silver pulled back very quickly thereafter. It's still down by maybe 5% from there. And here's the reason I did that, is because that is the environment when everybody is bullish and everybody's in. That's when you are going to get a pullback like that. So that's just a tactical trade of mine. Now, at this point, if it goes higher and my puts don't pay off, that's fine. I'm not going to get wrecked. If silver pulls back to 24 and I sell the rest of my puts and we make some money, that's fine. It's not going to change my life, but those are the types of tactical trades I will do along the way, in addition to my overall long-term strategic hold of gold or other assets that I don't trade in and out of. So in other words, I never short gold. And the reason I don't short gold is we could wake up tomorrow morning, and for all the reasons you and I have already discussed today, gold could be at $4,000. So the last thing I want to do is be short gold. But I'm not afraid to buy puts from time to time. I'm not afraid to hedge things from time to time. I think when everybody's on one side of the trade, then I think you need to be ready for it to go the other way, at least in the short term. So I'm extremely bullish gold long term, but I want people to be careful. I don't want people to just blindly go put 100% of their portfolio into anything, even gold.
Let's come back to the dollar crisis on page 11. What you're showing there is that from here in coming months and years, we may be headed toward a global crisis. I think you're right on that. My view is that the escalation to a hot war between United States, Russia, and Iran has probably just been put on hold until after the election, but I think it's coming. And I agree with you that it means dollar goes higher, it means interest rates go higher, it means inflation continues to run away. And I think your view that creates a crisis where the dollar appreciates is exactly right. Does that hit a crescendo at some point where it causes the rest of the world to, it seems to me, as you said earlier, the biggest problem with the dollar for the rest of the world is so much debt around the world is denominated in dollars. At some point, does the rest of the world say, look, we've got to redenominate our debt and stop paying it in dollars, not so much for the sake of de-dollarization as a sanction against, taking out our grudges against the United States, but just because we can't afford to resolve debts this way. Does something happen that changes all of this to where it reverses?
Yeah. So what I think happens, Eric, eventually what happens is when countries finally make the decision to take the tough economic pain that would be associated with de-dollarization, I think that process itself, again, is part of the chaos that pushes the dollar higher. But eventually, the dollar gets so strong, either because of military conflict or because of this economic chaos or because of, everybody just gets together and decides and says, this can no longer continue. It's not good for anybody. Then I think that there will be a reset. Now, whether that's another Plaza Accord type crisis or event that takes place in relative peace, or whether it takes place as a result of some, treaty post-military crisis, I'm not smart enough to know that. I just know the odds are stacked in favor of the dollar going much higher because of either economic chaos or military conflict. Ultimately, the worst thing in the world for the monetary system and the best thing for gold, ironically, in the long term, is a strong dollar, because a strong dollar literally wrecks the entire monetary system. And they will have to either reset it or do something to kind of fix it, write the dollar down. But again, I don't think that happens at DXY 105. I think that probably ends up happening at DXY 130 or 140 or 160. I know for years I've said the DXY will go back to 150 or its all-time high, and that's just kind of a marker out there. I actually think that will ultimately happen. I think it will probably take longer for this to happen than many people think. I think a lot of people think we are very close to the edge, that we're going to have this big event in the next, 6 weeks to 6 months, and then the dollar is going to be dead and we're going to go on to something else. I think the timeline is more like 6 years. I think it probably takes another 3, 4, 5 years for this crisis to really kind of hit in spades. And then, and it won't happen in a straight line. That's the other thing is, perhaps we get the dollar run to 115, then it pulls back to 105, then it goes to 130 and it pulls back to 118. And then we get some kind of a big crisis and it goes to 150 overnight, and then it's all said and done. Again, this is all speculation on my part. I don't know, but what I do know is that the design of the system makes it extremely difficult for the dollar to just get whittled away and just inflated away, and just it loses, the DXY goes down versus its fiat peers, and it eventually just loses its global reserve currency status in some kind of a peaceful manner. I think that is probably the lowest probability event that I could come up with.
Brent, while we're on this topic of the U.S. dollar relative to its fiat peers, I want to go to slide 19 where you've got some context on that point specifically.
Yeah, so I think everybody knows that the world has gotten way over its skis into debt, and financial repression is probably the way out. Governments throughout history have always inflated away the debt. Part of the reason I think the U.S. dollar will outperform its fiat peers is because the U.S. only has debt in U.S. dollars. The rest of the world has debt, not only a huge amount in their local currencies, but they have a huge amount in dollars. And as a result, because those currency pairs trade opposite to the dollar, you can't simultaneously inflate away your local currency debt and your US dollar debt. If the Fed decides to financially repress the dollar and the dollar goes lower versus its fiat peers, then it makes it easier for the rest of the world to service their US dollar debt. But it makes it much more difficult to service their local currency debt. And it makes it much more difficult for their export economies to export as their currencies are stronger versus the dollar. And this is the position that the rest of the world has themselves in. And vice versa. If they decide to financially repress their own currencies and to kind of inflate their way out of their own local debt, then you get the dollar rising dramatically versus their currency. This is exactly what you're seeing in Japan right now. So again, this part of the problem, and why I think eventually we're going to have the dollar at its all-time high, and it's just going to have to get a reset, because it's just going to cause too many problems. The system just doesn't work this way. So, hopefully that kind of helps people understand the situation that the rest of the world is in, and one of the advantages the U.S. has versus the rest of the world.
Brent, under normal circumstances, given that you have a dollar going up view, that would suggest that commodities would perform poorly because, they're priced in dollars. So if the dollar's going up, the price of commodities like copper and agricultural commodities and so forth would all be going down. That's not at all what we're seeing. We're seeing, particularly in copper, some really strong strength. Does that jibe with your theory? Am I missing something there? Or why don't we translate this view into a number of different asset markets? Because I see you've got quite a few slides on the deck on various different commodities and other assets.
I think a large number of people out there believe that because they know that the governments are going to have to inflate away the debt, then the simple answer is just load up on real assets. As fiat gets debased, commodities go higher and everything is easy. I don't think it's going to be that easy. I think we're going to get into this stagflationary state where some assets do very well and some assets don't. Now, year to date, the overall commodity index is only up like 3, 4, 5%. So it's up, but not dramatically. But the interesting thing is some hard assets, some commodities have gone up a lot. Like oil's up, 15% year to date. Copper's up 17 or 18% year to date. I think, now I don't know, but I think that both oil and copper are going to pull back over the summer and into the fall. And part of the reason I say that is because we're heading into an election. The last thing that Joe Biden needs is spiking inflation heading into an election. And so my guess is there may be some stuff going on behind the scenes to try to get these both lower. Now, whether they can do that or not, I don't know. But the other thing, like copper has had a great year to date, and it's had an amazing month. But copper has gone up so fast, so quickly. And part of the reason I think copper has gone up so much is because of China has recently started to do more stimulus. Their market has started to rebound a little bit. And I think this geopolitical tension, people are starting to stockpile a little bit, kind of these necessary commodities. So I think that's behind a little bit of copper's rise. I think in the short term, copper is going to pull back, not because I don't like copper, not because I don't understand that it's a very highly prized commodity, especially in some kind of a geopolitical war or, supply chain disruption. I just think it's come too far too fast. Its RSI, its relative strength is as high as it's been in 5 years. Its sentiment is as high as it's been in 5 years, and it's just gone straight up. So I think in the short term, that needs to pull back. But if it does pull back, that's probably something you want to buy. Same thing with oil. I think if oil gets back down into the $70 range, you probably buy it. Now, the biggest frustration for me in commodities is the area I have been most bullish on for the last, call it 9 months, and where I remain the most bullish going forward is the soft commodities. Last fall, I think really shortly after I was on your show, I bought wheat, corn, and soybeans. Now, all three of those have been pretty frustrating. Wheat is basically flat from where I bought it, but it's been significant time below. And both corn and soybeans are about 10%, 5 to 10% below where I bought them. So that's been frustrating. But I do think that that's an area where I think because of, again, geopolitical events, because of weather patterns, and because everybody still needs to eat, I think we could see some very big moves in wheat, corn, and soybeans later this year. You maybe perhaps some things like we've seen in both cocoa and coffee over the last couple of weeks.
Brent, before I let you go, let's just touch on the S&P 500 on page 30 for people interested in the stock market implications of all this.
Sure. Well, I think every time I've come on here, Eric, I think I've shown you the same slide. And this is just a long-term trend/channel chart of the S&P 500 that I show. And, part of my theory is that the equities are going to go a lot higher in the years ahead because of fiscal policies in the U.S. I think capital will flow into the United States. I think QE will come back probably at some form in some fashion, whether domestically or internationally. I think that money will flow into the U.S. And as money leaves the bond market, again, if we get into the situation where money flows out of bonds, I think the U.S. equities will be a place that they seek refuge. Now, I don't think that happens in a straight line. I've always said there will be terrifying drawdowns along the way. I think we're overdue for another drawdown. I don't know if we'll be able to pull back. It's 20% down to the top of this channel. I don't know if we'll get lucky enough for it to pull back there. I would love it to pull back all the way there. But if that happens, I would probably be a buyer there. And I think in the years ahead, we're going to see the S&P 500 much higher than we do today.
Brent, I can't thank you enough for a terrific interview. Listeners, I do encourage you to peruse the slide deck because there's quite a few charts we didn't get enough time to talk about, but some really great content there. For people who want to follow your work and also understand what services you offer, please tell them a little bit about what you do at Santiago Capital.
Sure. So Santiago Capital is a wealth management firm. I have about 15, 16 clients. They're all, very wealthy, very successful. Total assets that we have under management are around 175 million. We customize our portfolios to every client. So we don't have a model portfolio or a mutual fund that everybody goes into and everybody does the exact same thing. I'm a very big believer in diversification. I know over the last couple of years, it's been very popular to put all your eggs in one basket and then watch that basket very closely, as I think Druckenmiller said one time. I don't think that's the right way to do it. I still believe in diversification. I think having assets allocated to the United States as opposed to overseas is the right way to be. We build diversified portfolios, and we we have things set up in a way where we can participate in the upside, but we're not going to, we also have protection on the downside so we don't have to suffer through these 20, 30, 40% corrections that many long-only managers have. So if that applies to anybody out there and they're looking for that type of service, I'd be happy to talk to you. Our typical minimum is 3 million and higher. It's not because I don't think a lower amount needs help. It's just that for a number of regulatory purposes, that's kind of the number that we've stuck on.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Brent back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on that red button over Brent's picture saying, looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory.
EIA printed a massive build of 7.3 million barrels, Cushing, Oklahoma building 1.1 million barrels, gasoline building 344,000 barrels. The only drawdown on the board was distillates this week at 732,000 barrels, for a net petroleum build of 6.9 million barrels, almost 7 million barrels. U.S. production holding steady for several weeks now in a row at 13.1 million barrels, unchanged. The market fell below $80 on WTI, at least, on the big inventory build news, coming on the back of geopolitical tensions moderating, at least for now. As our friend Dr. Anas Al-Haji has emphasized in the past, there's plenty of room for further geopolitical escalation to add more war premium to oil prices. But with plenty of OPEC spare capacity, the ingredients just aren't there, at least not yet, for a return to $100 plus oil prices. And I also think that geopolitical tensions will escalate in the next 6 months. But the Biden administration will do all they can to delay that re-escalation of oil-sensitive military conflicts until after the November elections. So to my thinking, the market is eventually headed much higher, but it should continue to correct lower until there's a re-escalation of geopolitical tension, which of course is nearly impossible to predict the timing of. So I'm flat and focused on other markets.
Eric, in my eyes, we had an oil market that was reacting to geopolitics. Those things all calmed down, and we now had a mean reversion come in there. We're temporarily broken below this 50-day moving average. But in my framework, this is the type of a correction that we look for the opportunity to buy dips on. And actually, down in this zone is an interesting level in this next few dollars here, this kind of $78 to $80 pocket, where I'm going to be looking to see whether oil establishes a swing low and trades back up towards last month's highs. So it'll be interesting to see whether or not the supports come in here. Now let's move on to equities. I want to get Nick involved in the conversation. Nick, let's start off with that S&P 500 and just the levels you're watching.
Spot price right now, Patrick, is approximately 50.20 on SPX. We have an implied move for the May 17th monthly OPEX of plus minus 130 points. Therefore, the upper implied move is 51.50 and the lower implied move is 48.90. Right now, we have key resistance at 5,100 and key support at that 5,000 mark that we tested out yesterday. So yesterday with FOMC, we saw the market whipsaw around, trading off lows back up to around the 50.80 mark before falling back down into close and closing near the lows again. I'm inclined to think that we see a move lower given what Powell discussed. He didn't really change his overall stance on the Fed discussions because, again, the dot plot hasn't really changed at all for end of year right now. And so the expectations of Fed rate cuts haven't really changed from what was said yesterday to before yesterday's expectations overall.
So I like to step back and think about what has happened here over the last half a year. I mean, we had one of the most epic bull runs on a 5-month sustained basis where markets were close to 30% on the upside, and we were long overdue for a correction. And so that certainly got underway in April. The bigger question was the correction over when we hit that swing low at 5,000 just over a week ago? And one of the things that I was watching was whether or not the market could sustain any rally above 5,200, which would open the window for retesting highs and put the ball back in the court of the bulls. But with the fact that we had this pop and drop on the Fed, maybe there's opportunity for reaction still on the Apple's earnings or the jobs numbers. But generally, the market remains distributive in its nature and leaving that downside window for further correction still quite open. If we clear below 5,000, which was now a key support line, the 50% retracement area is 4,800, which is something we've talked about for several weeks now, and that is on the table. The bigger question is that this just going to be your plain vanilla 10% correction that is bought on dip, or does this turn into something more of a liquidity event? At this stage, I think the base case is that we're still in some form of a market correction, and when we get down towards those lower support lines, it'll be interesting to see whether or not it emerges as some good buy on dip opportunities going into some sort of a summer rally. Right now, you're right, it's a little bit of a downside risk, and we're going to see whether or not that follows through. So let's move on to the Nasdaq. What levels are you watching on the Qs?
Right now in Qs, spot price is approximately 425. We have an implied move for the May 17th monthly OPEX of plus minus 14 points. Therefore, we have an upper implied move of 439 and a lower implied move of 411. Right now, we have key resistance at 435 and key support at 413. With the majority of the Mag 7 earnings out of the way, we have Apple coming up next. If they report well, I expect to see perhaps a small pop in the market overall for tech. However, given the overall response to tech earnings thus far, aside from Google, we've seen some lackluster responses to the downside predominantly. Tesla reported poor quality report overall. They had a bounce, but they were already trading very low overall and very oversold. Amazon had a good report. They haven't really done much overall. Meta had a good report with poor guidance for next year. They fell substantially overall. And right now, what we're seeing is basically Apple and Nvidia are next up. We saw SMCI report as well, and they fell substantially, as well as AMD, who also fell too. So right now, earnings will be guiding the rest of the way. But it's really up to Apple now and NVIDIA to determine where we go next.
Yeah, obviously these earnings were relatively important, but when I step back on it, Nick, and just look at the price behavior of the Nasdaq, it really has just lined up with the S&P 500 and the overarching view of simply that we had an epic bull run on the upside that's now in correction mode is still, I think, the overriding driver. And we'll see, obviously, the Nasdaq is going to have some key support just under 17,000. If there is one more leg lower, it'll be interesting to see if the bulls can dig in and hold the line there. Now let's move on to the volatility index, because obviously that short-term low near 5,000 on the S&P came along with a material spike in volatility. We saw the VIX temporarily trade up to the 21 level on the upside. Since then, we've mean reverted all the way back down to the 15 handle on volatility. But it's interesting is that the market is only a stone throw away from its previous low, yet with volatility down at these lower levels, it seems like almost like that fear of grabbing at volatility premium isn't back yet, in spite of continued deterioration in the price action. What's your take here on the volatility index?
Yeah, so with the VIX at around 16 right now, we can expect intraday top-to-bottom moves of about 1%. What we're seeing is suppression in the short term of volatility by zero DTE selling of premium out of the money. However, we're also seeing larger blocks of insurance being purchased in the form of puts on longer dated options. Right now, the asymmetry of risk is pretty good to the downside if you're buying insurance, if you're using certain strategies like spreads or butterflies, for example. However, don't discount the fact that we have seen these bounces off 10% declines that have been pretty substantial, and it's possible we rally into end of the year. Moving on to page 7, we have the US dollar index. Eric, what are your thoughts here?
The Dixie is consolidating just below the 106 level. I'm leaning toward the next leg being higher, but as Brent said in the feature interview, if we go a lot higher from here, a lot of things will start to break. It's still unclear where U.S. monetary policy is headed between now and the November elections. Remember Jim Bianco's call that if the Fed was going to cut interest rates at all this year, they'd have to start in either the May or June meeting in order to avoid the appearance of election-related political bias. Well, the May meeting has now come and gone just this week, and that leaves only the June 12th meeting as the Fed's last opportunity to cut rates, assuming that Jim has the call right, on perception management ahead of the November election.
Yeah, Eric, the dollar index had a great run and has approached those 2023 highs, and that was largely due to the collapse of the yen and the U.S. dollar rally against it. That was a huge contributor to it. And now we've seen that intervention. You see on page 8 there, we had that big melt up in the U.S. dollar against the yen, and they came in and intervened. And essentially now it's likely that there's going to be overhead resistance here. It really now is going to depend on a lot of the other cross currencies as to whether the U.S. dollar has another imminent leg higher. The euro breaking down, let's say, toward 105, and the pound sterling rolling over here are going to need to occur if the U.S. dollar was going to have a continuation pattern. Otherwise, as we approach this overhead resistance, this could be the top end of a trade range into the summer if we see the currencies stay much more muddled. So at this stage, I'm still U.S. dollar bullish, but on the short term, there's some key resistance here, and it's going to be important to see how this price action settles in here in the next week.
And moving on to page 9, we have that gold futures chart. What are you guys thinking here?
I'd summarize the market condition as waiting for the other shoe to drop. There's a very important technical support level right at 2,300, where an important trend line and the 34-day moving average are co-located. We saw a textbook test of that technical level on Tuesday afternoon and evening of this week, followed by a reasonably strong rejection of that level going into and after the FOMC meeting on Wednesday. The question now is whether that 2,300 level is going to hold as support, and there are cases to be made on both sides of that question. Frankly, it makes perfect sense to me that it should not hold. We're long overdue for a correction, which is part of any healthy bull market. And the 50-day moving average is still way down in the 2220s. So a deeper correction than we've seen so far would make perfect sense. But the catalyst that's enabled this correction to begin in the first place has been geopolitical de-escalation. And it seems there's a couple of things that might imply re-escalation on the near horizon. Ukraine has begun firing U.S.-supplied long-range missiles at Russian targets in Crimea. And as of the time I'm recording this, the scale of the Russian response has yet to be determined. Meanwhile, I'm still very skeptical that Israel and Iran are just going to work their differences out and avoid another re-escalation for a prolonged period of time. So if either of these geopolitical risks rematerialize, that could end the correction, and the 2,300 level that's already been tested could be it in terms of where this correction goes. But absent some kind of geopolitical catalyst to hold that level, I think a deeper correction down toward the 50-day moving average somewhere between, say, 2220 and 2250 is probably the more likely outcome absent a geopolitical re-escalation.
Yeah, Eric, I have that 50-day moving average here on that chart on page 9. To me, gold had a great run. And it just like all markets, they correct. And this was all along going to mean revert to create the next buy on dip opportunity. I'm still pretty adamant here that this correction is now getting to this level. That I was looking at this 2250 to 2300 area as a tactical buy zone, and we're now testing that area directly. Now, that doesn't mean it's imminently going to turn up, but this is an area of high interest for me to be looking at playing another upside move, at minimum to retest the previous highs. Though moving on to page 10, I just wanted to quickly make a note on the copper chart. So copper has traded all the way towards its 2022 highs, slowly approaching that 475, 480 area. It's really been a very bullish run on the upside, and it's certainly been a lot of money made there. But this, like all markets, this is now due for some sort of a mean reverting correction, no different than what we just saw in gold. And at some point here, I think copper returning back to 430 to 4.25 is entirely plausible. And I think at this stage, I need a tactical pullback to be looking for a new buy opportunity.
Now, moving on to page 11, we have that uranium chart. Eric, I'm always interested in your thoughts.
The U.S. Senate finally passed the widely anticipated Russian-enriched uranium import ban, which many analysts have anticipated could be the catalyst to launch the next leg higher in this uranium bull market. President Biden is expected to sign that bill any day now, and the ban itself becomes effective 90 days after his signature. There will be waivers that are possible, but so far DOE is signaling that they're not going to grant any waivers unless there was no alternative. And by the way, high prices are not going to be an excuse or a justification for getting a waiver. As of Wednesday's close, spot uranium had moved higher on the news, but several of the uranium miners in my portfolio were actually down on the day Wednesday, implying a buy the rumor, sell the news reaction to the Senate bill passing. But then again, equities generally in the broader market traded down hard on Tuesday and Wednesday. So it remains to be seen whether or not the passing of this bill will be the catalyst to launch another leg higher for the mining stocks.
So, Eric, just based on price action alone, I really wanted to see that U308 get back into the 90s to really support the idea that the Sprott Physical Trust could break out above 30 and make it stick. We are getting that now. And so it's really interesting. Obviously, it has a headline tailwind behind it. We certainly have breakouts, and the correction has now lasted several months. And so all that overbought state that we were in at the start of the year has been unwound. And this makes it very interesting to see whether or not the bulls can follow through here. If they do, another bull leg could really take us into the tail end of the year with a solid advance. And so let's see whether the bulls can make it stick. Finally, though, I wanted to move on to page 12 and just touch on the wheat chart. And I chose wheat, but really when you look at soybean or corn, we finally have seen a scenario where after a 2-year decline, we finally seen some characteristics of bottoming. And then we're seeing that these consolidations are really basing. Now, we haven't seen that really translate to big turnarounds in a lot of the ag stocks or anything. But, this seems like a very early stage to be looking and seeing whether or not these bear markets are over and whether or not there's new opportunities here in the ag space.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as the slide deck from Brent and the charts that we just discussed here in the postgame, including a number of links to articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.